Hey class. Again, these are just some videos I've put outside of the normal class content. I put them on YouTube in the event they're helpful to review. Trying to keep them short and to the point. Okay, so if you're just jumping in and you're trying to follow this, please go back and watch the other two videos. One of them I called Basic Accounting Equation. The other one I called Basic Accounting Equation Advanced. Okay, so once we understand the basic accounting equation, the purpose of this video is going to be to talk through how we record things in this grid. Now, in accounting, we don't really use a grid, so this is just a way to think about things. Okay, and this is the way we've covered it in class. If you had accounting somewhere else, you may not have learned it this way, which is fine. Typically, if you learn it another way, it becomes a little bit more memorization. But if you look where we're starting here, here's the basic accounting equation, right? Right here across the top. Basic accounting equation. Assets equals liabilities plus equity. Now, if you watch those other videos, you know that I talk about the four pieces of equity. And I've put those kind of here colored by my definitions. So capital, dividend, revenue, expense. Right? Capital, dividend, revenue, expense. So capital is an investment into the business. Dividends, personal use. Give them back to the shareholders for personal use. Revenue is provide a good or service. Expenses are costs that are used up or incurred to generate revenue. Okay? So I'm just going to run through this grid. This is Sally's car wash. So the second I say Sally's car wash, you start to think, well, what good or service does she provide? Well, she washes cars. What costs does she have to use up to generate revenue? Well, you know, you've got a list here, but insurance, gasoline, and so forth, okay? So hopefully you can see this. I know it's probably a little bit small, so I will read it out loud. Sally starts up a business by investing $10,000 of cash in exchange for stock. So when we read that, cash is going into the business. So we go positive cash, right? Cash goes up. Investment into the business. Now that's called common stock. She received 100 shares of stock. Cash goes up. Investment in the business. Now important, we are doing the accounting for the business, not for Sally. So don't get confused. The business's cash is going up. Sally's cash is going down, but we're not doing the accounting for Sally. Okay, B, purchase a power washer for $1,000. Pay cash. Okay, well in accounting, when we show a negative number, we're going to put it in brackets. And I'm going to go ahead and just quickly kind of format this so that they're red. Hopefully that will make it a little easier to see. Okay, so we've got cash going down. Well, why did cash go down? Well, because we got a power washer that's going to benefit us in the future. All right? C, wash 3 cars and is paid $1,000. Well, when we hear wash cars, you should hear good or service. Wash cars, good or service, right? Done. So when we come over here, revenue, $1,000. Cash goes up, $1,000. D, purchase an insurance policy for 1 month. Pay cash. Now, in reality, on today's date, we haven't used up the insurance yet. But we know that the definition of an asset is material future benefit. So when we think about this insurance, we know that by the end of this month, it's going to be used up. And since we're doing the accounting for 1 month, we can be a little bit efficient and we can go right to expense. Because there's really not a significant future benefit. It's only for this month. It's going to be used up really quick. Okay? So when we do this, $200, we can put that to insurance. Cash was paid. Good to go. Okay? E, pay for gas with cash for the power washer in the amount of $100. The gas will be used up quickly. All right? So I'm giving you a big tip there. Oop, I put that in the wrong spot. Nobody called me on that. Use up the gas, and we paid cash, right? Used it up, paid cash. Why did we use insurance and gas? To generate revenue. F, wash 4 cars. As soon as you hear wash cars, your mind's going, revenue. Good or service, $1,200. But the customers have not paid us yet. We send them bills. So we go to accounts receivable. And anytime you hear the word receivable, that's an asset. Okay? Receivables are always asset. Just like payables are always liabilities. All right? So let's keep going. Sally pays her employees $500 for the work performed during the month. The employees are paid with cash. Okay, well, Sally's cash is going down. Why is she paying her employees? Well, she used them for the month. So we go to our expense here. All right. Sally pays herself a $200 cash dividend. She plans to go to Vegas. Now, she's really paying the shareholders, but in a small business context, she is the shareholder. So she can go ahead and do a dividend to herself. Now, if we had multiple shareholders, we'd have to be careful because dividends have to happen equal to the number of shares owned. But since she owns 100%, it's equal. She gets all of it. I go back to the gas station, fill up the power washer. Gas is $200. She forgot her wallet. The gas station will bill her. Well, that doesn't change the fact that that gas is going to be used up pretty quickly. Okay? The difference is we owe for it, right? Liability means we owe for it. J, purchase a piece of land that she plans to build a storefront on at some point in the future. Okay. Land is purchased using cash. Cash goes down. Land goes up. Right? Now that would be a long-term asset, probably in the investment section of the balance sheet, but that's where we're going to put that. Sally discovers that there's a similar name business operating in the next town. She pays the person $2,000 to acquire the trademark. Okay? So I'm just trying to get you to see an intangible asset. Future benefit. If you have a trademark on a name, there's a future benefit there. So the trademark is going to go up. Cash goes down. All right? And then the last one, you can see it down here at the bottom. Record depreciation. So this is an early introduction to depreciation. It's always kind of a strange one to me in accounting textbooks when this gets brought in. But depreciation is the process of allocating the cost of an asset over its useful life. Okay? So to say it differently, depreciation is recording the usage of the asset. So what this problem does here, L says record $100. You used $100. And we know expenses mean used. Now where it gets a little strange is we now get introduced to a contra asset account. It is an asset account that has an opposite balance. Okay, so these two together, if we look at these accounts, help us keep track of the power washer, and from a book, an accounting perspective, how much we've used up. So far you can see we've used up 1/10, 100 of the 1,000. Okay? So that gets us through the first month. Now if we're using Excel, we can do equal sum, open parenthesis, and we can add these up. We could go ahead and copy it all the way over. And if we've done it correctly, it has to balance. Now, what I like to just do, hopefully this might help some of you, I'm going to go assets, and then I'm going to do L and E over here. So I'm going to do a formula to add up the asset section, and then I'm going to do a formula to add up the liabilities and the equity section. And then I can copy this down, and if I do it right, they better equal each other. They better all net out to 0, because if they don't, I've done something wrong, right? Hopefully you can see it there underneath me. All right? Now some cool stuff. You could stop listening here, but I hope this video is maybe somewhat helpful for my students. If we prepared an income statement, the first statement we prepare is an income statement. The income statement only has 2 categories on it, revenue and expense. Okay? So if we were trying to do an income statement, we would first add up the revenue, which is the $2,200, and then we would add up the expenses, which are all of these. That's why I like the grid. It keeps them all together. So if we put these together, our net income, Brian made a formula error there, is 1,100. Revenue minus expenses. Okay? That's what our income statement would look like. Now that doesn't have the right label or the proper titles, but very quickly we can say for period 1, for month 1, that's the net income. Okay? So the second statement you would typically do is a statement of retained earnings or statement of equity, which is just an expanded version. Okay? Statement of retained earnings, the first thing I'm going to go is, my keyboard decided to stop working. Where did it go? That's weird. Let me pause that. I'll be right back, guys. Alright, that was really strange. I don't know why it stopped doing that. So beginning retained earnings. Well, at the beginning of the period, we don't have any. We don't have any retained earnings. Plus net income. Well, the reason we do the income statement first is because we need the net income off the income statement. Less dividends. Equals the ending retained earnings. Right? There's our ending retained earnings. Super simple. Now, if we went further, we could then do a balance sheet, which is the third statement. Assets, I'm just going to add them up. Now, this is not a full statement. This is me being lazy and quick. Assets are 11,100. Liabilities, we only have one of them here. 200. And the equity, where we got to be a little careful, equity, right, is really the result. It is the two pieces that remained here. It's what was invested into the business. It is both contributed capital, which is the stock, and earned capital, which is the retained earnings. So what I'll do here is I'm going to go capital plus retained earnings. Right? Add these two together. Is it a coincidence that the total liabilities and equity equal the assets? No. Has to. Okay? Now, if we were going to go on, I'm not going to go on, we did it in class. If we were going to go on to the next period, watch how we roll forward. Okay? So, if you've read in the textbook or you had accounting, you maybe spent a lot of time learning about closing entries. All closing entries really do is it takes the revenue, expense, and the dividends, and it resets them so you can start again. Now, if you end the month with $2,000 in cash up here, you better start next month with $2,000 in cash. If something happened between 11:59 and midnight, something's wrong. So all I can do, watch this. Those all have to carry forward. Whatever you owe at the end of one is what you owe at the beginning of the next. Your contributed capital, that doesn't go away. But notice how the dividends, revenue, and expenses all got reset. They all go back to zero. So now we can start keeping track again for the future. Okay? Video turned out a little longer than I wanted, but I hope it's useful. Again, if you're not in my class and you're seeing this, it's really more designed for my students because you're fitting my flow, if you will, in class. But if this is helpful to someone else, just let me know. I'll try to do what I can to help. Okay? Thanks, guys. Bye.